We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Ed Steer from edsteergoldsilver.com. He writes a daily analysis of the gold and silver markets. Thanks for joining me today, Ed.
Well, good afternoon to you, Tom, and to your listeners as well.
So we are speaking here on Monday, the 15th of February, and you had kind of gotten in touch with me after the interview I did with Ted Butler. You guys obviously speak quite a bit and write about a lot of the same things, and I just wanted to kind of cover a couple of those issues with you from your point of view. So you write very extensive articles nearly every day of the week, and this discussion is very timely because you just wrote the monthly bank participation report, and in it you wrote about price spread differentials being paper thin in the Comex futures markets and even some backwardation in the July and September period. So why don't we start off by giving a definition of what these terms mean and what the repercussions are?
Well, basically, when you see these price spread differentials, it's the cost of rolling over a contract into a future month. So we got March silver deliveries coming up here in 2 weeks. And the cost of rolling over, say, from March to the next delivery month, which is May or into July or September or whatever, normally is up around 16, 17. It can be whatever the banks charge, whether they want the longs to take delivery, they want them to roll over. Right now, the silver market is so tight in the futures market and in the physical market, they're desperately trying to get as many contract holders that would normally stand for delivery in March to roll into future months. So the cost to the long holder to roll over is like pennies or fractions of pennies per ounce. So if you own one contract of silver, which is 5,000 ounces, you want to roll it over into, say, July, it's going to cost you like $50 or $200. It's next to nothing to do that. So they're encouraging these rollovers because they don't want any people more than necessary of these long holders standing for delivery. And so right now the price spread differentials are very, very tiny, not only on silver but on gold as well, because they're just trying to encourage people to roll rather than take delivery. That's how tight it is out there.
Mm-hmm. So is that kind of covered in the backwardation as well?
Oh, absolutely. Backwardation, actually, when you see backwardation, and there's backwardation in September, December in silver right now. It's only like a tenth of a cent or 0.2 of a cent. But the fact that you even see it at all means there's huge, huge shortages in the metal. And the stress is just absolutely unbelievable. We had, I think it was on Monday of last week or the week before, when the Reddit Robinhood crowd got involved, that we actually saw backwardation in March, May, of 5 cents or something like that. It was absolutely horrendous. The banks managed to get rid of that price difference, but like I said, if we're talking 1 or 2 cents per ounce to roll over a contract from March into May or whatever month, it's basically they're letting you do it for free. So whether it's in backwardation or not is really irrelevant, but the tightness is still there. You can see it.
Mm-hmm. So can you explain to our listeners the enormity of the short position held by the big 8 commercial banks and why is it so significant? And maybe add when this price suppression started.
Well, the price suppression in silver has been going on ever since the Comex futures market was invented for silver. I think in gold it was 1973. Don't know when it was for silver, but the chart I sent you a couple of weeks back showed the short positions of the big 8 traders, and it's the concentration of the 4 big traders that's really become an issue now because they've gone major short in the last couple of weeks. And what you have basically is you have thousands of traders that trade in the Comex futures market. And what we have right now is we have a situation where 8 of those traders, all of them bullion banks or investment houses, are short more than 50% of the entire Comex futures market in both silver, gold, platinum, and I think it's the same in palladium, but I know it for sure in gold, silver, and platinum. You have 8 traders, all of them bullion banks or investment houses. And basically, when you're short more than 50% of the market, you control the price. And by going short, they keep the price suppressed. And it's 1 or 2 big banks out of the big 4. But basically, like I said, it's 8 traders against the entire world. Because if you go into the commercial category where these banks are located, they're short, but every other bank or commercial trader is long the market. So it's these 8 banks against the entire world in the Comex silver market.
Yeah, and I think that's important to highlight is exactly what you're saying, Ed, is that other than those big 8, everybody else in the commercial category, all of them are net long, right?
Yeah, absolutely. There's nobody that's short except the big 8 banks. Every other commercial trader is smart enough to know that this price management scheme is going to come to an end real soon, and everybody's just super long because the big 8 shorts have been hung out to dry. I think as of last Friday's Commitment of Traders report, these 8 banks were short 114% of the commercial net short position. So they're just short up the wazoo, and they're the only things preventing the price from blowing sky high, which would be, if they let the price go, it would be a rather large 3-digit number before the end of the day. That's how obscene and grotesque this whole situation is.
And as always, we'll include a link to those charts and also put them up in the YouTube video for all our listeners to see. But how many days of silver production is this short equal to, Ed?
I think on Friday it was 179 days. So these 8 traders are short 179 days of world silver production. I think that comes out to about 412 million ounces. So it is absolutely obscene and grotesque. And I'm just talking about silver, but right behind silver is platinum. The big 8 traders are monstrously short platinum and monstrously short gold. Not as much, but so close behind it, it really doesn't make any difference. Mm-hmm. It's, like I said, these 8 traders basically are sitting on the price of everything right now.
Yeah, so obviously the big commercials were caught off guard by the attention that silver has gotten as of late. So how are they reacting to this? And tell us how effective they are at controlling the price. And again, I'll include one of the charts here. You have the price change chart contrasting, let's say, platinum versus silver price changes over the last week and month.
There's absolutely no question they were caught completely flat-footed on this. They didn't see this coming out of left field at all. And so there was no question in anybody's mind by looking at the price activity that they were at battle stations in there and they were going short, especially the big 4. I think Ted mentioned in his column that they were the big short. They went short about 6,000 or 7,000 silver contracts short over and above what they normally do to cap the price and drive it back down, because if they hadn't stepped into the market, we'd be, like I said, we'd be looking at a silver price now in the hundreds and hundreds of dollars per ounce, which is where it's going to end up sooner or later, one of these days. But these guys are fighting for their lives right now, because for the moment they let silver go, the price go, they're basically, as companies, they're going to be sunk.
Mm-hmm. So can we talk a little bit about the price disparity between the spot price versus the price and even premiums being charged for physical? Like, how much are people paying for physical ounces versus what the quote unquote spot price is?
Well, the premiums are absolutely through the roof if you can find the metal. I know before I came on the show, just from my own interest, because I didn't know if you were going to ask that sort of question or not. But, you're looking at, in Canadian dollars, you're looking at prices of $10 over spot, $12 over spot. And it's the same thing at all the places you can buy physical bullion in the U.S. Either don't have it, and if they do have it, you're going to pay through the nose for it. There's just no physical metal to be had. And I worked in the retail bullion business part-time for 4 years, so it's something I'm very familiar with. And the lead times from the mints are just enormous. It's a very long, very thin pipeline, and it doesn't take very much physical activity for it to clean that thing out right back to the smelter, and that's exactly where we are right now. It's going to take many, many months for the dealers to get back to anywhere near where they were as far as physical inventory goes. It's a very, very tight physical market. It's also a tight physical market in the 1,000-ounce bars, too, because that's why the spread differentials have tightened into like pennies on the ounce. It's because the physical market is not only strong, but is also the commercial market is strong, too, for 1,000-ounce bars. And I'm sure we'll get into SLV and SIVR in a minute, but the market is tight absolutely everywhere you look.
So, Ed, in your opinion, do you think that if this tightness in the 1,000-ounce bar continues, could this possibly cause, a cascading effect of some of these, let's say, wholesale silver users to try and stockpile a little bit or a couple 1,000-ounce bars so that they don't have to shut down any of their production?
Oh, absolutely. I mean, as Ted said on the phone today, and as he said in the column that he put out in the public domain a couple of weeks ago, do not awaken the sleeping giant. And that sleeping giant is the commercial users, the Teslas, the General Motors, the Sonys, Apple, you name any company out there, electronics company, or any company that manufactures anything, because silver, although it's only a tiny component of the manufacturing process, is absolutely vital to what they do. And the moment they get a whiff of any kind of shortage, you can bet your last nickel they're going to be in there buying up everything you can, and it's going to make the situation just astronomically worse than it already is. And the situation has developed just in the last 2 or 3 weeks or last month, as everybody knows. It's accelerating now, and it's getting worse and worse all the time. So once the commercials get a sniff of the fact that they aren't going to be able to get supplies anytime soon, then the mad rush is going to be on, and it's going to be Katie bar the door regarding the price.
So, Ed, I'd like to turn a little bit to talk about what the commercial's motivation was initially to really, set up all these shorts. And obviously their motivation now is to not have to cover, right? But what was their motivation to begin with?
Well, their motivation to begin with, and I had something in my column about it last week, is that the world runs on a paper fiat currency system. And in order to keep everybody in bonds and in stocks and everything that was paper rather than physical, what they had to do is they had to make a grand decision at some point that they were going to go out and suppress the price of all the physical commodities out there. And that decision was made, 20, 30, 40 years ago. But at least since we got off the gold standard in 1971, the gold convertibility standard, and now that it's unlimited fiat printing, the decision had to be made is to keep people out of hard assets and keep them in paper assets. This has been going on, like I said, since 1971. And, of course, they've been printing more and more money, so they found it more and more difficult to keep commodity prices in line. But what they discovered is that if they keep the big 6 commodities in line, the 4 precious metals, copper, and West Texas Intermediate crude, as long as they control those prices, then the rest of the commodity complex would fall into line. But we've now reached the stage where there's no inflation out there. As a matter of fact, there's deflation, and the powers that be are now desperate to get inflation into the system. And this is what they're fighting right now, is they're trying to prevent commodity prices from rising, which want to rise. And in some ways, the powers that be actually want them to rise, but now the big 8 shorts in there, which include a lot of the commercial banks, have found themselves in a situation that's no win. It's either death by one single thrust or death by 1,000 cuts. So it's the situation which has been festering now for the better part of 50 years since we got off that gold standard is now coming to a head, and we're seeing it playing out in real time right in front of our eyes at this very moment.
So does all of this possibly lead to a currency crisis and a major loss of confidence in the dollar?
It could lead to a major currency crisis in every currency if this thing becomes like it did back, say, in 1980 when we had the last big run-up in silver and gold. People lined up around the block to buy the stuff. The financial system has been on its last legs for, the last 20-odd years. They've managed to keep it propped up through, quantitative easing and money printing and zero interest rates or negative interest rates. You call it what you want to call it. But the paper system is that we have right now is very long in the tooth. No paper currencies ever survived, none at all. And this paper system we're on, whether it be the U.S. dollar or Canadian dollar, the pound or the euro, the yen, or whatever you want to call it, these currencies are long past their best before use date. And there's no question about it that a major run on precious metals by anybody, whether it be the commercials or everybody, the commercial traders, covering short positions, or the people that actually use the stuff in business, or the general public going out to buy the stuff, it could all come to a head here very quickly. And there's no question about it that the currencies would suffer, principally the U.S. dollar.
Mm-hmm. So, Ed, it makes me wonder what the possibility of this scheme continuing is. Like, considering how much capital and power these banks have, is the only way to break the system that has been operating for the last 50 years to make the Comex, let's say, default on deliveries and forcing the spot price up, and thereby forcing these banks to have to start covering their short positions?
Well, there's only 2 ways to cover a short position. That's either to buy along and extinguish the short or deliver into it. And there's no way on God's green earth with the situation as it exists today that they're ever going to be able to cover physically. So the Comex has been operating normally. They haven't failed to make delivery yet. But there's no question about it. The March delivery month is going to be very interesting. Ted said that on his column on Saturday, and I agree with him 100%. Could the Comex fail here? Anything is possible. After what's been happening over the last 2 or 3 weeks, all bets are off the table as to what could happen. The shorts could be forced to cover, but I can tell you right now, if the shorts are forced to cover, it will drive virtually every one of them into bankruptcy unless, say, something like the Exchange Stabilization Fund comes along and bails them out. But right now, the situation is very, very fluid, but it is not in the Big 8 shorts' favor whatsoever. Sooner or later, they're going to be forced to either deliver or cover, and I can tell you if they decide to cover, well, as Jackie Gleason used to say, to the moon, Alice, to the moon.
So, of course, most that are familiar with the story are also familiar with the role that JP Morgan has played throughout the years. But as Ted Butler pointed out, they basically have closed their short position in silver, and they've been stacking physical silver. So are they trying to position themselves to profit once the price goes higher and front run this?
Yeah, that's precisely what they're doing. There's no question about it. When they took over Bear Stearns in, 2008, at the behest of the Treasury Department, I'm sure the Federal Reserve, to take them over, they inherited Bear Stearns' short position, which is the reason they went under, because Ted said there was a $2 billion margin call they couldn't meet, so that's what caused the company to go bankrupt. But JP Morgan has been at the center of silver and gold ever since then, since 2008. And they've completely covered their short positions in gold and silver, and that big price, $300 or $400 price soon we had in gold and $10 or $12 in silver that we had last March was all engineered by JP Morgan for the sole purpose of covering their entire short position, which they did in spades. And now they're basically market neutral. They may be long or short a couple of thousand contracts in gold and silver, but basically compared to the 30 or 40,000 contracts they were short way back then, it's basically nothing. So what they've done is they're out, like you said, as like Ted said, they've been buying up all the gold and silver they can for the last couple of years or last 10 or 15 years since they took over Bear Stearns. And he figures they've got 25 million plus ounces of gold and control of at least 1 billion ounces of silver. So, it's a pretty fair statement to say that, they're all set up for this thing to go sky high. And like I said, the situation is very fluid, but trust me, JP Morgan's in this for themselves, and they're going to do very well. Thank you very much.
And just to kind of reiterate that, Ed, they basically took the opportunity to cover their short position when prices kind of crashed in March?
They caused the price to crash, okay? And in the process, okay, they engineered that. You see these big price declines we see, those are all engineered by whatever party, but Ted says there's no question about it in his mind that JP Morgan initiated that crash, drove the prices lower through spoofing and all kinds of other illegal things that they do. And in the process, they covered their outstanding short position. That's what happened back in March.
So you have another interesting chart here that shows the transparent silver holdings versus the silver price. So tell us a little bit about what that's showing us and kind of contrast that to the gold chart as well.
Oh, well, it's amazing to watch. Those are the charts that Nick Laird provides that I use in my column every Saturday. And what it's showing is basically that the amount of silver going into the silver ETFs has been basically nonstop since its inception, 10 or 15 years ago. And especially in the last year, it has gone absolutely straight up. The amount of silver going into these funds in the last year, say the last 3 years, if you take a look at the slope on the chart, and like you said, you're going to post them with the link so people will be able to see them. It is just absolutely phenomenal. Everybody out there in the world, especially the players that are in the know, the big money players on the inside, these insiders all know what's going on, and they've been buying the SLV and every other ETF and mutual fund you can possibly imagine. And of course, they've been depositing this physical metal left and right, and the only person that's got this physical metal is JP Morgan. And of course, Ted's of the opinion that JP Morgan is actually leasing this metal rather than selling it outright. So they still have controlling interest in it, and these various and sundry authorized participants who they lend it to, whether it be Citigroup or other banks, the Big 8 shorts, basically the Big 8 shorts, are in double jeopardy. Not only short in the Comex, but they're also short physical metal if they owe JP Morgan. So you're seeing massive amounts of silver going in. It's just what happened in the last 2 weeks. 111 million went into SLV, and that doesn't include what's gone into the other ETFs. It is just absolute runaway mad accumulation of every last ounce of physical silver that exists. And while that's going on, the silver price continues to languish around $26 or $27 because the big 8 shorts are sitting on the price. And versus gold, gold is doing well, of course, but it's basically hasn't done much for the last several months because all eyes are on silver, and that's where the big money, the smart money, where the insider money is going. And it's not about to stop. And with what's going on out there right now, this silver price management scheme, days are very much numbered.
Interesting. So as we're talking about the gigantic inflows into the ETFs, is it possible that they've been able to source all of the silver that they say they've been adding to their funds, Ed?
Oh, absolutely. No question about it. I am, there's a lot of people that say, well, they don't have the silver and they're doing this and they're doing that. Well, the short report that came out last week certainly indicates that there's no short position in SLV worthy of the name. So there's no question in my mind that, JP Morgan's got a huge warehouse in London. And all they do when they transfer money, because they're the custodian for SLV and SIVR, I believe. Mm-hmm. And all they do is if a bunch of money goes into SLV, for instance, say 20 million ounces or 50 million ounces, all they do is go out on the floor of their warehouse, and it's monstrous. And they just change the tags on the pallets of who owns all these pallets of silver from JP Morgan stash over to the custodian or over to SLV. It's I have no doubt about the silver's there, but even JP Morgan is in the bottomless pit, and I can tell you right now they've pretty much reached the end rope of how much they're going to lend out. And so it's just mind-boggling how much is going in there, but there's no question that the metal's going in there. It's just the authorized participants are on the hook for it.
Mm-hmm. So one of the other things that people are, let's say, questioning here, Ed, is the outflows out of the SLV. We've seen people basically converting their shares for the physical metal. Is that right?
Exactly. That's exactly what is going on. Ted's been writing about this now for years, okay? And it's most obvious what happened here in the last 3 weeks. We saw, 110 million go into SLV in the space of, 3 or 4 days, a week or something like that. And then we saw some big, big withdrawals. Now, those, like you said, those aren't withdrawals at all. Those are people who go in there and they buy 100 million ounces. They say, okay, fine, I want to convert. One day they say, I want to convert 30 million. The next day they say, I want to convert another 20 million. So all they're doing is taking their SLV shares, going back to the authorized participant and saying, I'm redeeming these shares for physical metal. The metal never moves an inch. All that happens is it goes from SLV ownership to the ownership of the person who converted the shares. That's exactly what's happening because it is in price environment. And the circumstances that we see today, nobody's selling an ounce of anything. Everybody's buying. So that's what's happening in SLV and some of the other ETFs like SIVR, I'm sure.
Perfect. I think that could clear up a lot of confusion here. So one of the other, I guess, important things to be highlighted here is about the prospectus changes in the last week to SLV and SIVR. So what are the importance of these changes?
I'll tell you what, that is the really, really big news. It was when it came out this weekend, it was absolutely enormous. I said in last Saturday's column, this was before these prospectus changes came, I said, things are now in motion that cannot be undone. Mm-hmm. And that is exactly what's happening today. When I saw those changes go up, I said, man, you could see that all of a sudden the prospect of the world running out of silver, swallowed up by the SLV and all the other ETFs out there, is becoming so critical that even BlackRock has taken notice of it. And Ted figures that JP Morgan has probably whispered, and somebody here said, look, we can't supply silver forever. We're going to have a real problem here. And so SLV, of course, will be the first to know because JP Morgan is the custodian. Mm-hmm. And SIVR, JP Morgan's also custodian for that as well. So if they have done it, I can tell you right now, and Ted said this on the phone today too when I was talking to him. He said, look, if they're doing it, everybody's going to be changing their prospectuses like mad because if SIVR and SLV can't get the silver, nobody else is going to be able to get it either. So you're going to see a mad rush for these prospectus changes over the next 2 or 3 days because there's just no physical silver to be had, and woe be gone the shorts. Anybody who's short any of these stocks is going to be in real trouble.
So as you and I were talking about before the call, basically the next in line after SLV and SIVR is PSLV. So if they're not able to get silver, that affects them, right?
Oh, sure. It affects everybody. I don't care who it is, whether they're the biggest one or the smallest one. I mean, you can go to somebody number 10 down the list and deposit 500,000 ounces with them, and they say, look, I'm sorry, we just can't get the silver. And it's going to affect everybody equally, but the three biggest silver ETFs mutual funds out there are in order are SLV, SIVR, and the Sprott. That's a PSRV or whatever it's called. Mm-hmm. Those are the three biggest ETFs in the world, and if they can't get silver, nobody else is going to get it either. This is coming to a head real quick.
So I was just going to ask you, Ed, is it fair to say that this is fairly imminent and could be fairly catastrophic for the silver industry?
It is impossible to overemphasize how far-reaching and disastrous this could be for a myriad of markets, not just the silver market. Because they've been suppressing the prices of gold, silver, and platinum and palladium and the big six commodities for so long. When this thing finally does blow up, it could take the entire commodity complex with it. And anybody that's short could be it's going to be in serious trouble. We're going to see major bankruptcies unless the Exchange Stabilization Fund steps in. Because they cut this thing right down to the wire and they haven't tried to bleed this thing off at all. It's just, they let silver and gold prices rise naturally, we wouldn't be in this situation we are in today. Mm-hmm. But because they fought this thing hammer and tong, tooth and nail, right down to the very last good delivery bar, an explosion of some kind, whether it be financial, economic, whether it be silver-related or gold-related, it's really impossible to know how this is going to turn out. But I can tell you right, it is going to be ugly.
Mm-hmm. So in all likelihood, though, what do you think the chances of the exchange fund stabilizing this, though? Because we've always seen, let's say, the Fed backstop any real negative catastrophe in the market.
Well, the Exchange Stabilization Fund is probably backstopping some of the silver shorts, especially with their critical ones like maybe Citigroup or HSBC or whoever else is they consider to be deemed too big to fail. But it's who's ever number 9 or 10 or 12 position. I can guarantee you that if silver blasts through $100 or whatever, there's going to be a lot besides the big 8 shorts that are going to be in financial jeopardy, and it only take 1 or 2 of semi-key players to start dragging. It's going to be like long-term capital management, and it could easily get away from this. Is so big. We're talking trillions. We're not talking billions.
Well, Ed, that's pretty illuminating point to, let's say, conclude things on. Do you have anything else you'd like to share with us?
No, but we live in the most extraordinary times. It's impossible for any person, me included or anybody else, to overstate the gravity of the situation that is about to fall on not only the precious metals, but the entire financial sector, because like I said, there's going to be blowback and spill over into every other market. You couldn't make this stuff up. Mm-hmm. And all I can do is say, man, if you got physical, hang on to it. And just be long and strong everything and hope there's a world left to survive in once this is all over.
Well, Ed, I really appreciate your illuminating conversation today. Tell our listeners where we can find more from you and your writing.
Yeah, I write one column 5 days a week, edsteergoldsilver.com. It's $100 US for about 260 columns per year. And you can go to my page and there's a sample column there. You can read it. And you can see what you get for your money. And if you decide you're interested, well, you're more than free to sign up.
Excellent, Ed. Of course, we'll link to that in the show notes as well. Thanks very, very much for your time and your info today, Ed.
And thanks for having me on, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.